What if I told you that a single $1,000 invested by a young boy with a paper route would grow into a personal fortune of $165 billion without winning the lottery, founding a tech startup, or striking oil? This is not fiction. This is the real story of Warren Buffett, the Oracle of Omaha, who turned patience and strategy into one of the greatest wealth-building stories of all time. Today, Warren Buffett is hailed as the world's greatest investor. Since 1965, his company, Berkshire Hathaway, has delivered a mind-boggling 20% annual return, crushing the broader market and creating generational wealth for shareholders. But Buffett's journey wasn't built on flashy trades or lucky bets. It's a masterclass in long-term compounding, disciplined value investing, and resisting the chaos of short-term thinking. So, how did a boy from Omaha, Nebraska, selling gum and Coca-Cola door-to-door, end up building one of the world's largest conglomerates? What were the key decisions, risky bets, and game-changing moments that transformed his first $1,000 into a financial empire worth over $165 billion? Stay with me, because as we retrace Buffett's journey, you'll discover the powerful investing principles that anyone can use. Yes, even if you're starting small. And wait until you hear the story of the $25 million candy company that would go on to make him billions. That's coming up in just a few minutes. Warren Buffett's obsession with money and business started early. Born in 1930, young Warren devoured books on making money. One title in particular, 1,000 Ways to Make $1,000, sparked a fire in him. By age 6, he was selling gum and Coca-Cola to neighbors. By 11, while other kids were playing baseball, Buffett was buying stocks. With $114.75 saved up from his paper routes, Warren bought 3 shares of Citi Service preferred stock at $38 apiece. But the stock quickly dropped to $27, testing his patience. Eventually, it climbed to $40, and Warren sold, feeling smart, until the stock soared past $200 a share soon after. It was his first big investing lesson. Impatience can be costly. But that wasn't the end of young Warren's hustling days. His teenage ventures, from pinball machines and barbershops to buying 40 acres of farmland at just 14, proved he had a knack for spotting value where others didn't. By the time he finished college, Buffett had saved nearly $10,000, equivalent to around $180,000 today. But his true investing education began when he stumbled upon Benjamin Graham's The Intelligent Investor in 1950. Determined to learn directly from the father of value investing, Buffett enrolled at Columbia Business School, where Graham taught him the art of buying $1 for 50 cents, what Buffett would later call cigar butt investing. After earning his master's, Buffett landed a job at Graham Newman Corp., learning the ropes of deep value investing. By 1956, with just $100 of his own money, he started his own partnership, managing $105,000 from family and friends. His fee structure was fair, no fees unless returns exceeded 6% annually, after which he took 25% of profits. Within a few years, his partnership's returns were an eye-popping 25.9% annually. One of Buffett's early masterstrokes was his investment in Sanborn Map Company. Wall Street had written the company off as a declining map maker, but Buffett noticed its stock traded at $45, while its cash and investments alone were worth $65 per share. He quietly acquired 43% of the company, forced a buyback of shares at their true value, and scored a 44% gain for his partnership. This wasn't luck. It was classic Buffett, finding hidden value others ignored. Buffett's big breakthrough, though, came during a scandal that rattled Wall Street. In 1964, American Express was hit by the infamous salad oil scandal. Fraudulent soybean oil inventories caused its stock to crash. While others panicked, Buffett focused on the bigger picture. Americans were still using their Amex cards daily. Seeing the company's brand and trust intact, Buffett boldly invested 40% of his fund's capital into Amex. It paid off, and this marked a turning point. Buffett realized that great companies with strong brands could weather short-term storms better than cigar butt bargains. By the way, if you're finding Buffett's story as fascinating as I do, hit that like button. It really helps this video reach more people who want to learn the art of investing like the Oracle of Omaha. By the early 1960s, Buffett was a millionaire. His partnership had over $7 million in assets, and his personal cut exceeded $1 million. Then he spotted a struggling textile company called Berkshire Hathaway. Its stock was cheap, trading below the company's assets. He started buying shares, initially as a value play. But after a dispute with the CEO, Seabury Stanton, Buffett took control of Berkshire outright. One of the few times emotion got the better of him, as he later admitted. The textile business would drain resources, but Berkshire would eventually evolve into his ultimate investment vehicle. Buffett's style shifted dramatically after meeting Charlie Munger, his longtime partner. Munger pushed Buffett to move beyond cheap dying companies and focus on quality businesses with wide moats. The defining test of this new philosophy came in 1972 with See's Candies. At $25 million, See's looked expensive. Buffett almost walked away. But Munger convinced him the brand's pricing power and loyal customers made it a cash machine. Decades later, See's has generated over $2 billion in profits for Berkshire. It was the deal that reshaped Buffett's entire investment approach. In 1973, Buffett bought a $10 million stake in the Washington Post, which would grow to over $1 billion. In 1976, he rescued Geico from near bankruptcy, a move that would later turn the insurance giant into a crown jewel of Berkshire Hathaway. Buffett was no longer just picking cheap stocks. He was building an empire of exceptional businesses. Buffett's biggest 1980s triumph came with Coca-Cola. After the 1987 crash, he poured $1 billion into Coke stock, buying 6.2% of the company. Within a few years, the stake tripled. Today, Berkshire earns around $700 million in annual dividends from Coke alone. By 1986, Buffett officially became a billionaire, proving that long-term compounding, not short-term trading, was the real key to wealth. As the 1990s unfolded, Buffett remained steadfast, while others chased the frenzy of the dot-com boom. He famously avoided internet stocks, not because he disliked technology, but because he believed in investing only in businesses he deeply understood. While Silicon Valley was minting paper millionaires overnight, Buffett was quietly building long-term stakes in proven giants like Gillette, Wells Fargo, and American Express, companies with enduring products and powerful brands. When the tech bubble inevitably burst in the early 2000s, Buffett's disciplined approach was vindicated. His legendary patience shone again during the 2008 financial crisis, when global markets were collapsing. While fear gripped Wall Street, Buffett stepped in as the lender of last resort. Through Berkshire Hathaway, he injected billions into blue-chip companies like Goldman Sachs and General Electric, securing deals with high interest rates, favorable terms, and stock options. These crisis-era investments not only stabilized the companies, but also delivered massive returns to Berkshire over the next decade, cementing Buffett's reputation as the calm, steady hand in a storm. In one of the most surprising chapters of his career, Buffett made a historic pivot toward technology, a sector he had long avoided. In 2016, Berkshire Hathaway began quietly buying Apple stock, eventually investing over $30 billion. Buffett didn't see Apple as just another tech company. He viewed it as a consumer powerhouse with a brand loyalty few businesses in history could match. With its seamless ecosystem, iPhones, iPads, MacBooks, the App Store, and recurring services, Apple had something Buffett cherished, a wide and growing moat. As he later remarked, iPhone users weren't just customers, they were devoted fans, unlikely to switch brands. His conviction paid off handsomely. Today, that $30 billion investment has ballooned to well over $160 billion, making Apple the single largest holding in Berkshire's portfolio and one of Buffett's greatest all-time wins. By 2021, Warren Buffett's personal fortune had officially crossed the $100 billion mark, an astonishing milestone for someone who never relied on flashy ventures or inherited wealth. As of today, his net worth is estimated at $165 billion, a figure built entirely on the back of consistent, long-term investing. Buffett's approach is deceptively simple. Buy great businesses at fair prices, hold them for decades, and let the unstoppable force of compounding do the heavy lifting. What began as a humble $1,000 saved from paper routes and small hustles has transformed into one of the most legendary fortunes in history, a testament to the power of patience, discipline, and the courage to stand apart from the crowd. Warren Buffett's story isn't just about money, it's about discipline, patience, and avoiding the temptation of quick wins. You don't need to find the next Tesla or Bitcoin, you just need to find great businesses, understand their value, and hold on. If you enjoyed this breakdown of Buffett's journey and want to see more deep dives into legendary investors, hit subscribe, drop a comment on what you found most inspiring, and don't forget to check out our free stock analysis course linked in the description.